Hey everyone, it's time for another episode of Mayhem in the Markets. Before we dive in, this gentleman in the blue jacket, his expression is quite similar to mine during the last hour to half hour of trading on Wednesday, when we had the reaction to the Fed, but also to Janet Yellen, and it wasn't a good reaction. The market sort of went full illiquid into a bit of a free fall. It wasn't a crash, but it was basically just an illiquid sell down, where sellers just smacked the bid over and over. Market makers were nowhere to be found. The depth of the book on Wednesday was between 4,000 and 8,000 contracts most of the time, which is about 80 to 90% lower than where it usually is. And that allowed price discovery to be effectively taken over by sellers who just kept pounding price lower. Then, of course, we re-explored the scene of the crime on Thursday. But what was really interesting about that price action was just how dramatic some of those 5-minute candles were on the way down. Anywho, this episode is all about what caught my attention over the last week. Charts I've shared on my Twitter feed, which you can find at Mayhem for Markets. That's Mayhem number 4 Markets. You'll know you're at the right place because there's about 140,000 followers. And even though I don't pay for Twitter Blue anymore, there's still a blue check mark too that says I'm verified because I'm a subscriber. So you'll know you're at the right account. But without further ado, let's talk a little bit about what's going on in the markets. First with gold. Bullish bets outpacing put buying on a 5-day rolling trading volume average by nearly 4-fold. Now, what does this tell us? It tells us that people are scared. Gold is a hedge against uncertainty. And one thing we know is this is an ever more uncertain market. In fact, Powell said that word uncertain quite a bit during his press conference. And I think this might put a little bit of a cap on the gold rally. There's just too much bullish positioning in the options market. You can see it in the change in skew, rising more to the call side in some of these expirations, particularly more near-dated ones. And that's just telling us the market's participation, people's views as they are putting them forth in the options market are just a little bit too lopsided to the bullish side. Doesn't mean the gold price has to crash or even have a major correction. It just increases the odds of sideways to down in the near term. And we've seen this before. There were similar bullish bets placed on gold after the Russian invasion of Ukraine. That did mark that top there as well, although that was much more dramatic overall. And I think a lot of people that had been going very long gold then, or possibly even earlier this year, may be starting to look to get out. Gold has a very, very effective way of burning both the bulls and the bears, as people might see looking at the charts over the years. So I would just say if you're very long gold here, maybe caution is warranted. If you're a trader, if you're a longer term investor and your time horizon is many years, I don't think it really makes a big difference because, you're not necessarily trying to time the market. Maybe it's more of a hedge against uncertainty or other sorts of things in one's portfolio. But for shorter term traders, this is a warning sign. It means that sentiment and positioning have become lopsided to the buy side, and that could set us up for some sideways to downward action. Next, we have U.S. bank deposits have seen a steady drip since last fall. And this is really interesting if you think about it, because the bank deposits, they really peaked in early 2022. Part of that was the effect from the COVID stimulus running off. Another part were the concerns about inflation that we've been talking about at TraderAid, at my own YouTube, on my Twitter, and so forth, that have been running high. That is to say, consumers are spending more and more on everyday goods, and they're not saving nearly as much money. In fact, the excess savings rate has fallen to levels we haven't seen since 2005, and that was the lowest it had ever been. So a lot of that stimulus has worked its way through the system. People bought a lot of goods from late 2020 through early 2022, but now they're really just focusing on buying what they need. And this is a sign that we're seeing some people really tapping out. Another sign is credit card borrowing getting close to a $1 trillion level, which is a record. And this is with credit cards where the fees, the interest rates, they're rising. And I believe that's going to impact a lot of people negatively that are carrying this debt, because this is debt for essentials. The price of these essentials has risen over the last couple of years, and now interest rates are rising. So people are beginning to sort of cash out their bank deposits because of that, but there are other compounding factors as well. One of them is that money markets are increasingly very attractive places to park some cash. We can see that money market yields have risen to about 4.5% as of the creation of this chart. And there are other areas as well. Short-term treasury bills become increasingly attractive, yielding anywhere between 3-4%, not long ago 5%. I think that there's a lot of opportunities for people that want to get yield that don't involve a savings account or a checking account or a CD at most banks. Of course, some banks are offering very competitive yields, and I think over time, more banks will join them. We also see that retail spending is falling. Now, what's really interesting about this is a chart from Citigroup, and I apologize, it's a little blurry. It was from their own report that it came out like this. But the reason that it's very interesting and a bit concerning is, in real terms, retail spending peaked in May of 2021 and has been sideways to down from there. But what we're also seeing is, in nominal terms, retail spending is beginning to fall as well. We have that Christmas surge. You can see it on the chart. Happens pretty much every year. And then from there, sideways to recently down. Now, that probably sets us up for some somewhat disappointing retail spending numbers for March. But I think it also tells us that the consumer is not doing so well, because these are spending numbers in nominal terms. So people are at a nominal level spending more to get the same or less. When nominal spending starts to drop in an era of persistent inflationary pressure, food's still expensive, energy's gone down in price, but people are still having to pay a lot more than they used to. So to see that this spending is dropping as much as it has, really over 10% from the neutral level on the chart, that's a bit of a sign. I think it does tell us that consumption trends are pointing lower. Quarter 4 GDP also saw similar, where 0.2% of the 2.7% gain for that quarter was consumption. And a lot of the other contributors were unsustainable factors like inventory building and non-defense U.S. government spending, as well as a discrepancy of exports falling less than imports. None of those are things you can hang your hat on for economic growth. You really want to see consumption being the biggest part of that growth number, and instead it was among the smallest. So I think we're starting to see more weakness from these consumers. The seasonality of spending being higher during the holidays and right thereafter because of gift cards seems to be behind us. We're also looking at commercial real estate. The entire sector has some trouble, but particularly retail, office space, and warehouses. And there are some increasingly concerning maturity walls coming up. We have a sizable one this year, but we can see as the years go on, we do have a lot more of those maturing loans. Now, the question becomes, in a tighter credit environment with a higher cost of capital, how do these commercial real estate debts become refinanced, and how sustainable will they be when demand for the underlying, whether it's a mall or a retail store or an office building or a warehouse, is diminishing? In fact, we're seeing office space utilization in most places not get anywhere close to where it was pre-COVID, even after, several years of essentially being reopened. And I think that tells us that the work from home or hybrid work trends are here to stay. And that also, combined with the pressure that many businesses are seeing, means that commercial real estate is going to see a lot less utilization, likely for many years. Now, there are some solutions to these types of situations, one of which is retrofitting commercial real estate into multifamily units. And I think that might be a solution that some localities embrace because it's practical. There's a lot of places that also have a deficiency of residential units. And instead of building a lot of residential units, existing commercial units could be shifted over with some changes, some updating, and some zoning modifications, and that might be worth considering instead of, the current path of just sort of building more multifamily units and having a lot of idle commercial real estate with vacancy rates between 20 and 40%. And we see that small domestically chartered banks own, as this chart puts it from JP Morgan, the lion's share of commercial real estate loans outstanding. Now, this is not a good setup because we already know there's problems in the small banks. There's problems because they have mismatches in the duration of their assets versus their liabilities, which are their deposit accounts and their CDs. It's also problematic for a different reason, because these same small banks, their exposure to commercial real estate debt could put them in a bit of a bind. This is part of their loan book, or at least part of their assets, depending on how they acquired the debt, whether they made the loan themselves or bought it from another bank or consortium. And this suggests that we could see a rolling crisis at the credit level in some of these banks if commercial real estate really is going to be the problem that some suggest. Bank of America put out a note on Friday saying that they believe the next leg that could lead us closer to recession and pressure the stock market, that next leg down is going to be in commercial real estate. And I happen to agree. I think this is an area of underappreciated risk, and it will disproportionately impact these smaller banks. On screen, we've got the prices of commercial mortgage-backed securities at the lowest since October of 2009. So it's nowhere close to the lows we saw during the great financial crisis. It's not as low as it was in November of 2022, and it is lower than where it was during the COVID crash and the dot-com bust. This suggests stress. This doesn't mean that these are all distressed and that there's a whole big episode of commercial real estate defaults coming in the immediate future. What it suggests is that the possibility of delinquencies and of increasing stress in the commercial mortgage-backed security market is increasing. And as we go throughout the year, we may start to see some defaults as well. This will put pressure on those smaller banks, those regional banks, community banks, and so forth, where they have an inordinate amount of exposure. This will also have other collateral impacts on the broader economy because credit conditions will continue to tighten as banks take losses and as they become more conservative with how they issue loans. So I think that what we're seeing here is one of the pillars of support for these regional banks and these community banks falling. And this is a problem because there's already fear. People are already moving their deposits. We've seen, hundreds of billions of dollars leave these banks and go to the larger money center banks like JP Morgan or Citigroup, Bank of America, Wells Fargo, etc. And this is just going to potentially hasten that. If customers become less trusting of these banks, thinking their deposits may leave, that can also create situations where the banks have to do unfortunate things like either borrow from the Fed at their discount window, which is a punitive rate. It's over 4.5%. And most of these banks have exposure to assets that don't yield anywhere close to that, giving them a negative carry cost, which is a great motivator to raise the rate on their deposits, attract more customers, get some more cash. But it also, doing so, imperils the spread between what the bank is lending out and charging and what the bank is earning on their deposits. And some banks may not be able to give very competitive rates on deposits depending on the composition of their assets and loan books. So I think all of this just points to a more stressful situation for these banks. And it's something we have to monitor because any kind of large-scale event in commercial real estate, in commercial mortgage-backed securities, would have consequences to other parts of the economy and financial system. So I'll continue to watch this. This is an area that we've been talking about at MacroVisor and at TraderAid. So if you don't follow my work at either one of those services, I suggest checking them out. It's if you're interested in this type of macro commentary, TraderAid is where I post more of the work that focuses on the short to intermediate term and in the more close up on various assets and tradable ideas. And then MacroVisor is the bigger picture, the intermediate to longer term, and the more detailed analysis focusing on macro. So those are two different projects that I'm involved with. MacroVisor just launched earlier this year. And I'm really happy to be able to offer that content to a broader audience. And if you sign up for MacroVisor's premium offering, you actually get a 50% discount for the first year. And that opportunity ends on April 14th. So you can check it out at macrovisor.com. On this chart, we've seen a surge in emergency borrowing, and sometimes that happens at a low or near a low in the market. But the real question is, when does the surge end and why? This is just the first leg up in discount window borrowing as far as we know. And we haven't really seen a rewriting of stocks in terms of their valuation. So if this was a market low that led to a new bull market, it would still be the most expensive new bull market in history. So I don't know that this time is going to be the same as those times prior. I have a feeling this time might be different because of the magnitude of some of the liquidity issues in the system due to quantitative tightening and the rapid pace of Fed rate hiking. Banking crises are often followed by tighter lending standards, and this is something that I think deserves a little bit of attention, because what this means, and we hinted at this just talking about this in one of our MacroVisor videos and podcasts recently, as well as some of the content we've posted there in article form. But essentially, what we're seeing here is likely to have knock-on impacts to the economy and to the level of economic activity that's happening. So when you see the Fed discount window getting so much usage, it translates to banks saying, look, we need to really change how we're running our risk here, because we don't want to be borrowing on punitive terms. So we're going to shore up cash. Maybe we'll raise rates on deposits when loans on our book mature. Maybe we will not lend out again when assets mature. Maybe we will not replenish those, and we'll shore up for the storm. And so that does mean that there's economic impacts. It means that there's a slower economy ahead, because this is a debt-driven economy. And not only has the cost of capital gone up, but the availability of capital has diminished. And looking through time, and this is not a chart that a lot of people maybe have looked at. I shared it on Twitter, but I wanted to share it here too, because it's very interesting to me that you see this adjusted for inflation, the sheer scale of the Washington Mutual Bank, or WAMU, failure in 2008. It was enormous. It's, in those real terms, adjusted for inflation, greater than Signature Bank and Silicon Valley Bank put together. So just something to consider. And you don't see Lehman Brothers on this chart because it wasn't a commercially chartered bank. So these failures in 2008 are interesting because of just how many there were. I don't think we're going to see quite that many this time, but I do think we have more to come. And this typically happens in waves. If you go all the way back to other banking crises like the savings and loan crisis or the Great Depression, there were a lot more bank failures. So I would suggest that there are more failures to come in small and medium-sized banks, maybe some more large as well. I think that we may have a situation where there's a rolling kind of series of failures that happens when we start to see more solvency issues emerge towards the late stages of this, and this really the end stages of this credit cycle, which we're beginning to explore now. But by the back half of this year, I think we'll see more stress unless something already big has broken and the Fed has turned around on its policy. And the S&P 500 is now more concentrated in the largest 5 stocks than it ever has been. The last time it was nearly this concentrated was in 2000 with Microsoft, GE, Cisco, Intel, and Walmart. This time it's Microsoft, Apple, Amazon, Alphabet, and Facebook in 2020. As of 2022, this has risen further to 22%. I believe Facebook was also potentially replaced by Tesla as the top 5, at least back and forth a few times during that period. Nevertheless, Facebook calling themselves Meta or something like that these days, this shows us that there's just too much concentration. 5 stocks make up 22% of the S&P as of September last year. That is a byproduct of passive flows. It's a byproduct of 5 companies really carrying the market so much. And I would say that it's a risk, and I don't think that these 5 companies will still be the largest 5 in the S&P in 5 years from now. But we'll see what happens, right? I think it's a lot of uncertainty, as Jerome Powell wisely said during the last press conference, awaits us. We've got no evidence of equity capitulation. That to me means we've got no evidence of a real bear market, but it does look like we see what we've seen before prior times of such a capitulation. That is sort of this topping period where people aren't buying anymore. They aren't selling yet. And I think we have the selling yet to commence, which typically happens during a recession when people are more scared of what might happen to their holdings. I don't think that we can get a real bottom in the market until we see some degree of sell down. Right now, we have the largest amount of equity exposure versus total net worth that we've seen in U.S. history. And latent recession risk has now spiked to 50%, yet the market doesn't seem to care. It's just sort of looking at this like, well, with the way stocks are priced right now, and with an earnings recession and a housing recession, the market still seems priced to perfection, particularly with risk premium being so low. And I just don't think that this is a situation where we get out with a no landing or soft landing scenario. I do think we have a hard landing, and I think we have a much more meaningful re-rating of stocks lower. The low 3000s or even below that, the high 2000s in the S&P would not be particularly surprising before all is said and done. Steepening builds in this yield curve. We're starting to see something that tells us a recession may be imminent. Often the yield curve begins to steepen out of a deep inversion when a recession is more imminent. So the duration of the inversion and the depth of the inversion might give some hints about how bad the recession may be, but it's not until you steepen out, as we are now, that you start to see the real risks of recession being imminent. Something to keep a close eye on. So thank you so much for your support. I really appreciate it. Like and subscribe if you enjoy my content. Consider sharing it with your friends. Check out my new project at macrovisor.com. We're having a 50% off sale until April 14th. That gives you a discount for your first year. So it's like a founding member discount. And we focus on the big picture, thematic trading and investing, as well as making macro easier and more actionable to everyone. Consider following me on Twitter if you don't already. That's Mayhem 4 Markets, Mayhem number 4 Markets. And remember to dream big and stay hungry for knowledge.